Welcome to the Nichols Tax Update Podcast, issue 2147. This program is produced to provide current information about developments in United States tax law. And the disclaimer goes on. The one thing I want to emphasize is at the bottom, the value in preparation of this program of my subscription to Tax Notes Today, published by tax analysts, in my opinion, the preeminent source of information for tax professionals, and I rely on it. As if you follow these programs every week and you subscribe to tax analysts, you'll see the items that I choose to emphasize show up in your own reading. Let's start with what's new this week. Changes to Circular 230 are now circulating in draft form. It's been 7 years, soon to be 8 years, since there were any significant changes in Circular 230. That's the rules for how we practice in tax. Interaction of the 100% limit on restaurant meals with the meal and incidental expense per diem is something that could be a puzzle for you if you don't think it through, and the IRS offers some help. Tax professionals may now order up to 30 transcripts per phone call and 5 additional transcript types from the IRS website, or the IRS utility for that. The tax court estimates a taxpayer's moving expenses. We talk occasionally here about the Cohen rule. Sometimes it works, sometimes it doesn't work. It worked like a charm in this particular case, and I want to talk about why it worked so well. Then a fact sheet that clarifies the tax treatment of COVID relief payments. Not all of them, just some of them, that an individual that receives a grant or COVID relief payment from a state government, where the state government received a grant from the feds. So there are all kinds of grant programs floating around. We need to know how to deal with all of them. I think we get a little guidance here. How-to videos. A series of how-to videos explain how to prepare an offer in compromise application. Warn against the offer in compromise mills. We see their ads on television all the time. If you owe the IRS more than $10,000, call us. We can straighten you out. The typical taxpayer with a high school education can do that application themselves if they want. And then 3 revenue procedures explaining how to account for forgiven PPP loans, where the PPP loan was directly to the taxpayer or the taxpayer's business. And finally, a no-brainer, I think, the value of gold coins is taxable when the owner of the IRA that owned a single member entity that owned the coins decided to take the coins so that she could hold on to them and touch the gold coins. She created a taxable distribution. Well, that's a lot. So let's get started. If you look up Circular 230, there it is. It's a PDF document. It hasn't been changed since June of 2014. Meanwhile, there's been a lot of activity, a lot of litigation on what the IRS can do and can't do, what rules they can enforce and what they can't. And then the tax practice has changed. And we don't need some of those rules in the same way. The changes that are being proposed are primarily to Subpart B and Subpart C. Circular 230 is Title 31, Code of Federal Regulations, Subtitle A, Part 10. Part 10 has subparts A, B, C, D, and E. Subpart A has the rules governing authority to practice. Subpart B, the duties and restrictions relating to practice before the IRS, that I refer to that as the ethical standards for tax practice. And then Subpart C is what happens to you if you violate Subpart B. D and E we really don't deal with that much. So I'm concerned and we're interested in the changes that are being proposed for Subpart B and Subpart C. I thought it would be well to look at those that are being proposed by the AICPA for Subparts B and Subpart C to get some sort of a summarized look at what's possible. The AICPA suggests that changes need to be made to address confidentiality, privacy, data protection, and record retention. Certainly in each of those we have new developments. Society has moved on. We have technology that's moved on or moved in and moved in. So we need to be addressing privacy, data protection, and record retention. We also need a couple of revisions to reflect the limitations that were put on the IRS and its authority to regulate practitioners in Loving and then again further in Ridgely. Those are cited there on the slide. The AICPA suggests, and I think it makes sense, that we should revise Section 10.22b so that it is properly aligned with Sections 1034d and 1037b regarding reliance on third parties. A revision to Section 10.28 would be good to consider current filing dynamics, such as electronic filing. We could add a clarification on the definition of client records, and we could clarify Sections 10.50 and 10.51 on the terms and conditions under which a monetary penalty will be assessed or imposed on the individual and possibly on the firm as well. So there it is. Let's watch for that, because when it hits, we all need to revisit our tax practice quality control documents to make sure that we maintain consistency with the AICPA suggestions and with whatever the IRS finally winds up doing with Circular 230, probably sometime this summer or this coming summer. Oh, these people are having such a good time. You think that they're on the expense account? Could be. Notice 2021-63. The IRS provides a special rule to apply the temporary 100% deduction for restaurant meals to the meal portion of a per diem rate or allowance. If you are using the per diem method to account for your expenses, that is, you're not keeping little receipts, you can treat the meal portion of a per diem rate or allowance paid or incurred after December 31st, 2020, before January 1, 2023, 2 years, as being attributable to food or beverage provided by a restaurant. That means it's 100% deductible. The entire amount of the meal and incidental per diem is now deductible. Before this notice, you had to reduce the meal and incidental expense per diem by 50% because the presumption was you were buying a meal, and there was a 50% limit on the deduction of expenses for meals. But then the law changed and we get a 100% deduction on restaurant meals. So there was conflict between the per diem rule and the COVID rule, and notice 2021-63 resolves that conflict. Tax pros may order more transcripts. Be still my heart. Information release 2021-226, middle of November. The IRS has increased the number of Transcript Delivery System transcripts that tax professionals may order through the Practitioner Priority Service line because they're not getting them and getting them out to us. We're not going to get any help from the IRS. I feel sorry for the folks at the IRS. They're taking a lot of heat. They're understaffed. They're overworked. They can't get all the stuff done. I think it's reasonable that they will let us do our work. So we now have expanded the number of transcripts we can get on one call from 10 to 30 and expanded the types of transcripts we can get. Here's a list. I can get a tax return transcript, a tax account transcript, a wage and income transcript, a value of account, and verification of a non-filing letter. All 5 of those that were not previously available are now available to me as a practitioner to get from the transcript order line. If you need more information, there's a link at the bottom of this slide. Enter the Cohen rule. Forrest Crawley and his wife appeared pro se, representing themselves. Her job changed. She had an executive position with UPS. and her job changed. She moved to Louisville or someplace. Anyway, they spent about $24,000 on the move. They cashed in $20,000 of her UPS stock so they would have the money to pay for the move, and they converted it to cash. And they paid their moving expenses in cash, including they paid a moving company, a mom and pop operation that had like 2 men in a truck, except that's a franchise, but they paid for some help, and they claimed these deductions. IRS audits the return. They don't have any receipts. Well, diligent IRS agent disallows all those claimed expenses. Mr. Crawley says, yeah, wait a minute. We paid those. We're entitled to that deduction. And so they file a petition, and up to tax court they go, looking for a summary opinion, less than $50,000 in tax involved. They know they can't appeal it. And so they come to court and they tell their story. They show what proof they have. They sold UPS stock. They spent about the same amount of money they got for the stock on the move. Well, obviously they had moved. The tax court judge was fairly thoughtful about that. They obviously didn't live in the same place they had lived. He understood that they moved, not only did they move their household goods, they moved a boat, they moved 2 jet skis, 2 motorcycles, 5 bicycles, a partridge in a pear tree. The judge was convinced, based on Mr. Crawley's testimony, that they did actually spend that money. Well, he quotes the Cohen rule. And this is exactly as it was written back in 1930. If a taxpayer establishes a deductible expense, but is unable to substantiate the precise amount, we may, after bearing heavily upon the taxpayer whose inexactitude is of his own making, estimate the amount, provided we are convinced that the taxpayer incurred such an expense and we have a basis upon which to make an estimate. The husband's testimony, along with gas receipts, hotel receipts, all the ancillary receipts, they didn't have a receipt for the big expense of the trucking, but they had everything else, and the judge decided that they had, in fact, by virtue of the husband's testimony, he was satisfied that they spent the amount of money they claimed. Now, I want to caution you, this result is unique. It's based on the facts, it's based on the husband's presentation in this case, and on the judge being convinced that the husband was telling the truth about how much was spent and for what. The Cohen rule depends heavily on the perceived veracity of the witnesses. And you need to make, before you trundle off to tax court on behalf of a client, you need to evaluate whether you think the client is going to be able to tell the story in a way that will convince the judge that even though we don't have the receipts, we actually incurred the expense. That's the Cohen rule. And a fact sheet clarifies whether or not a COVID relief payment is taxable. 14 frequently asked questions. The tax consequences for individual recipients of coronavirus state and local fiscal recovery funds. The federal government made grants to state and local governments of COVID relief funds. State and local governments in many then dispersed that money in the form of grants to individuals. One grant program had grant funds going to colleges and universities that evaluated the need of certain students that without a grant could not stay in school. And so the federal government gave the university the money. The university gave the money to the student to help the student stay in school. So this is similar to that, not exactly the same, but very similar. And what's taxable? Well, I get a grant, it's not taxable. The state gives me a grant, it's not taxable. But if I get a grant in order to help me keep my employees, and I use that grant money to pay their wages, that's going to be taxable income to the employee. I don't pay tax on the grant, but when I pay the employee as wages or a bonus, that's going to be taxable goes in the employee's W-2. That's what I learned by looking at Fact Sheet 2021-16. This has been an exciting week. How-to videos. The IRS has produced a really neat set of videos explaining how to prepare an offer in compromise. Get an overview of the process, the forms, and the pre-qualifier tool so the individual can figure out if they even might qualify before they start. Then a step-by-step walkthrough of the forms. How to complete Form 433A, Form 433B, all the forms necessary to provide the collection information that are required from individuals and business-related entities. Then a step-by-step example, videos produced by the IRS, a step-by-step example of how to complete the offer in compromise application, Form 656. Not easy, right? An amazing checklist prepared in a very thoughtful way, leaves nothing out. If an individual taxpayer with a high school education starts the offer in compromise process and watches these videos and follows what the videos explain, they will be able to complete an application for offer in compromise. They don't need any former IRS employees to prepare the application. They don't need any CPAs. They don't need any lawyers that advertise on TV for this. They can do it themselves. And all they have to do is follow the IRS guidance. Accounting and reporting for forgiven PPP loans. I don't want to talk about it a long time. There's all kinds of people have been talking about it now for a year. Finally, Revenue Procedure 2021-48, 49, and 50 explain when taxpayers should account for tax-exempt income from forgiven Paycheck Protection Program loans. That is, when should you file your report, how related businesses should allocate related tax items, and finally, how partnerships can amend their returns if they didn't take the most advantageous position in their original return claiming PPP loan forgiveness. Finally, this week, the value of gold coins is taxable when you take them from the IRA's single member entity. Individual is taxable on the value of gold coins that she took from a single member LLC that was owned by her IRA. According to Judge Robert Gokey, a qualified custodian or trustee must continue to be responsible for the management and disposition of self-directed IRA property. You have a self-directed IRA, you can instruct the custodian what to do with the money in the self-directed IRA. You can tell the custodian where to keep the coins, but you can't have the coins. If you take them home with you, it's going to be taxable income. Well, some serious stuff, some obviously big stuff, some small stuff, but it's a week. I come up with a big question mark. If you have questions, there's my email address, there's my phone number, and until next time, please stay safe.